Hi, I'm Linda Eedes. This is an update on the RECM Equity Fund, talking specifically to the second quarter of this year. I'm going to talk a little bit about the markets, about the contributors and detractors to returns for the fund, and talk about how the fund is positioned overall. So over the quarter, the fund was actually slightly down in terms of returns. It delivered negative 0.4% after fees, and that was in stark contrast to the JSE All-Share Index, which was actually up just under 4%. But if you look over the last 3.5 years, if you take a bit more of a step back and you look at how the fund has performed since a very important inflection point at the beginning of 2016, which marked a bit of a turn back to value-oriented strategies in terms of where performance has come from over that time frame. If you look at the returns for this fund, over that 3.5-year period, the fund has delivered 45% after fees, versus the All-Share Index, which has delivered 25% over that time frame. Now, what this points to is the fact that in order to outperform the All-Share Index by 20% over 3.5 years rather, we must be positioned very, very differently to the All-Share Index. The reason for this is that as value managers, we start with a blank piece of paper when we structure our portfolios. We want undervalued opportunities where the price is on our side, where the price is very low relative to what we deem to be the fair value for that business. Unfortunately, the price is low when businesses have gone through a tough time. Either that's a company-specific issue, it can be an industry-wide issue, it can be because of the economic cycle that they're tied to. But generally speaking, we have a contrarian edge to our investment style because we generally want to invest in businesses when they have been through a time which puts the price on the right side of the equation, where it's significantly below the fair value of the stock. So the reason why we are positioned very differently to the market is a combination of that value orientation, that style, being able to move away from the market quite significantly, being very comfortable with that, and also our size, the fact that we are a small value manager. So there are a few of the large firms which have more of a value orientation, and there are plenty of smaller managers in the South African market, but there are very few that are both small and value oriented. And that combination is very important because as a smaller manager, we can really use the full opportunity set available to us in South Africa to find value opportunities. And quite frankly, today we are finding them across the board. So if you look at our equity portion of our portfolio, it's made up, pretty much half of it is in large caps, which have come under pressure of late, many of which obviously we would know about because they are in many portfolios which use the All-Share Index as a starting point. But there is also a lot of value in the small and mid-cap part of the market. So what we have as a portfolio, which as a result of our size is very diversified amongst all of those different parts of the market. And I think there is a misnomer that sort of significant price action to the downside can only really be in small and mid caps. If you think about risk in that sort of frame, then if you think about what has made headlines over the last few years, it certainly has not been the small and mid-cap space. It's really been a lot of the large caps that have come under significant pressure. Stocks like, for instance, BAT, Steinhoff, of course, is the poster child for this, Tiger Brands, Mediclinic, Woolworths, all of these stocks are down more than 30%. So investing in large caps is not protection against extreme downward price movement. We believe that a value orientation is really your best protection against extreme downward price movement, which is permanent. So of course you might have some downward price movement which is uncomfortable, such as you had with Anglo American when it went down 75% in 2015, but thereafter it actually went up 8 times from that low point and doubled from before the time that it lost 75% of its value. So permanent loss is really generally as a result of overvalued stocks coming down to more realistic levels, and that's generally a more long-term adjustment that you will not get back as a result of the cycle turning. New stocks in the portfolio include a number of interesting and varied exposures. Some of them are small caps and some of them are larger stocks. They include Netcare, which is of course the private healthcare provider. That market has been under quite a bit of pressure as a result of medical aids, really squeezing margins, sort of introducing hospital networks where they've negotiated far lower rates away from some of these private healthcare providers. And of course, just the economic cycle, consumers being under pressure and medical aid membership dropping as well. So we had the opportunity to actually switch our exposure in Mediclinic, which we had for similar reasons, into Netcare, which is our preferred stock in the sector. It has less debt. It's further down the line in terms of clearing up its missteps into global markets, which South African companies seem to be particularly prone to. And so we took the opportunity to actually introduce a position in Netcare, swapping from our Mediclinic exposure. We also introduced exposure to Santova. This is a very small logistics business. Small in terms of market cap, not in terms of its actual reach. More than 60% of its earnings actually come from the likes of Europe and the UK. So you're really getting quite a bit of insurance against the rand there. And that business is really just not available to even the medium-sized asset managers. It's a great example of a spectacular business. It's trading in single-digit PEs, and we're able to take some meaningful exposure there. We also introduced exposure to Spur. Now, this is a 2.5 billion rand company. It's a high-quality business. It's come under some pressure of late because of the economic cycle. They had that boycott as a result of the sort of incident which went viral on social media, and they faced increased competition. There's sort of all sorts of things which have caused pressure on their business, but they will weather the storm, and we were given the opportunity to introduce a small allocation to the stock. As I say, great business, not available, no matter how attractive it is, to the larger managers. And that's really why having RECM in your portfolio can really provide you with access to opportunities that some of the other value-oriented larger managers just really aren't able to provide you with. Another stock which made it into the portfolio is Trendcore. Now, this is really local access to a international business. It owns 47% of Textainer, which basically is a company that owns cargo containers, or in actual fact purchases, leases, and resells cargo containers. That business essentially is now trading at less than half of its book value. So you basically have the opportunity within a South African-based mandate to get exposure to a global business of that nature, which is very attractively priced. So what we have overall is a mix of small caps, mid caps, large caps. We have a preference for higher quality businesses. We want at any one point in time to have more than half of the exposure to high quality business which are trading cheaply, but we do have this very varied opportunity set to undervalued businesses. And we think that's really your best insurance against not knowing exactly what's going to happen going forward. Having that margin of safety between what you've paid and the ultimate fair value of the business is your best provisor to getting good returns over time.